So far, we have gotten our toes wet by reading the first two chapters of our accounting textbook. We've learned the history of accounting, about uses of accounting information, as well as terminology and accounting rules. In Chapter 2, we looked at bookkeeping versus accounting and different career options. Now with Chapter 3, we will be learning about business transactions, business records, debits and credits, and basic reports. I hope you're ready to jump in with both feet. We begin the accounting recording process by determining that a transaction has taken place. There can be several business transactions that occur in a company every day. Some of those are financial transactions that should be recorded in the accounting record. Once we determine that a transaction has taken place, we follow these procedures to record and post the transactions and then to prepare a trial balance. The business begins with a chart of accounts. These are the accounts that will represent all of the different types of assets, liabilities, equity, revenue, and expenses of the business. The chart below represents how to use debits and credits to either increase or decrease the account balance. Here is a sample chart of accounts for a typical small business. On the left side are the balance sheet accounts, and on the right side are the income statement accounts. This is a very simple representation of accounts. Some businesses have several hundred accounts. Each of the accounts in a business can be represented by the informal T account. This is an accountant's tool to show the activity in each one of the individual accounts. These would also be included in the general ledger of the business. The cash account typically has the most activity of any of the other accounts in the chart of accounts. As cash is received from customers or paid out for expenses and other purchases, all of the activity is gathered in this account. Here are some other examples of T accounts used to represent our chart of accounts. Debits do not always equal minuses, and credits do not always equal pluses when you record your entries into the accounting records. Throw out everything you think you know or have heard about debits and credits. The left side is always a debit and the right side is always a credit, but whether a debit or credit increases or decreases an account depends upon what type of account you are using. The T account process of gathering all the activity involves analyzing each transaction and then following these steps. Here are 4 transactions that we will post into the cash account using the T account format. Once all these transactions, A, B, C, and D, are recorded, you can total both sides of the T account and then compare those balances, and the difference will be the balance of the account. The difference will be on the higher amount side of the T account. This represents your cash balance. Page 109 in the textbook introduces you to the contra account. These are accounts that act completely opposite of other accounts in their group. Sales returns is one type of contra account. This is a contra revenue account, and the slide shows an example of how that works. We have sweater sales of $1,500 and had customers return $500 of sweater merchandise for a net amount of sales of $1,000. It's important to keep the detail in the sales returns account so that we'll always know that our original sales was $1,500 and $500 was returned. A manager should know how much money had to be returned to customers and why these items had been returned.